Welcome to the Investopoly podcast. Our goal is to share easy to understand, evidence based, holistic insights to help you master the game of building wealth. My name's Campbell Wallace. I'll be filling in for Stuart today. We've got some great listener questions, which I'm going to jump into in a minute. But before we do that, I just wanted to give a quick market update, in particular around the global share market and in particular around the US share market, because what we've seen of late is one of the all time rallies, and it's worth commenting on and offering some insight into. So, I'm looking at the last 8 weeks up to the 22nd of May. So it's a little bit backwards looking, noting, at the time of recording this on the 11th of June, there's been a little bit of a pullback in the US share market of about 3 or 4% in the last week. But in any case, in the last 8 weeks, it's been one of the all-time rallies in the US share market that we've ever seen. So in terms of where it ranks in all-time rallies, so looking over the last 75 years, this comes in at the 20th biggest rally, 8-week rally over the last 75 years. So quite amazing what we've seen. It's up 17% in the S&P 500, the US market, over the last 8 weeks. And of course, that puts us at all-time highs in the US share market. So it brings it to 22 all-time highs so far in 2026. And it's off the back, of course, of a number of all-time highs in the past few years. So out of interest, going backwards in 2025, there was 39 all-time highs, 2024, 57, 2023, there were none, and then 2022, there was one, and then 2021, there was 70. So a lot of all-time highs really in the last sort of 5 years. But I kind of don't really like it when people talk about, all-time highs in the share market, because there should be all-time highs all the time, in my opinion. Well, why else would we invest in the share market? So it's a natural thing, I think. I don't think that should be the thing that is the concern, that there's all-time highs. I thought I'd just make mention of it. But, of course, that's why we invest in share markets. We want to see all-time highs, because if you're not, then you're not making money. So I just thought I'd make that comment because, I sometimes hear it in speaking with clients or listeners of the podcast who mention, share markets at all-time highs. And yes, it is, but that's okay if it's backed, if there's a reason behind those all-time highs. That's okay. And their all-time highs should be happening all the time. It's a normal thing. So that shouldn't be the thing. Well, it doesn't scare me away. What scares me away is when there's valuation issues. And I wanted to have a quick chat about that. But before I do, I want to look backwards. Let's look at historically the last time there's been such a big rally over an 8-week period. What's happened in the 12 months following that, or the 3 years or the 5 years? But let's just look at the 12 months after we've seen rallies this big in an 8-week period, because, historical evidence is, often a good indicator of what might happen. So it's interesting to look at this. So if we look at it, so this rally we've seen in the last 8 weeks, it ranks as the 20th biggest 8-week rally in the last 75 years of the S&P 500 market. So if we then look at the other 19 above it, biggest 8-week rallies, well, guess what's happened in the 12 months following them? On average, 27% return. And across all of those 19 years, there was 1 year where there was a down, a down market in the 12 months following it. All the other 18 times that this has happened, this 8-week rally of this size, there's been big gains posted. And the average across them is 27%. So, I can't, of course, historical data is not an indicator of future performance, as they say, as you hear on certain marketing. But, there's a historical indicator of what's happened in the past after big rallies like this. Looks pretty good if we look historically. So the question is, what's driving these returns and where are they coming from, and are they warranted then? Are they validated? Well, it comes from earnings, pretty much. The earnings per share. So if you look at the S&P 500 earnings per share, so this looks at per share on the S&P 500, what's the earnings of it? So it really drills it down to a unitized basis. Well, that's up 29% year on year, the S&P 500, and it's, expectations from commentators is it's going to increase by 24% this year. So that's a massive earnings per share growth in the last 12 months. To put this in context, so the earnings per share in the S&P 500 sits at around $337 at the moment. 12 months ago, it was $271. In 2024, it was $243, and the year before that, it was $220. So that earnings growth and earnings per share growth has been pretty exponential in the US share market. For comparison, the Australian share market in the last 12 months, the earnings per share growth has been about 12%, a bit more modest. Now, the reason I wanted to mention that earnings per share growth in the US share market is because that's a really important figure. And there's some people out there that are making similarities between what we're seeing in this big tech boom at the moment between the tech boom in 2000s and the big difference here. And that's the difference is earnings and profit. Back then in the 2000 tech boom, the valuations got just silly and really high valuations because they weren't being backed by earnings and profit and revenue. But amazingly, really, I think the growth that we've seen in the S&P 500 in the last 8 weeks, I think is almost warranted. It's based off earnings in the US share market. Now, of course, we can't talk about the tech boom in the US share market without mentioning Nvidia. I mean, what a company. This is incredible what we're seeing here. So Nvidia, to put it in scale, Nvidia now accounts for roughly 8% of the S&P 500. And then on a global stage, it represents about 5.6% roughly of the global share market. So as represented by the MSCI World Index. So this one company represents about 5.6% of the global share market. I mean, that's unbelievable. And you look at Nvidia's net profit margin, that's up to about 71%, up to the Q1 in 2026. So unbelievable numbers there. I mean, anyone that runs a business that understands that a 71% profit margin, that's just an incredibly profitable business. And looking at revenue, the revenue in the last 12 months is up 70% for Nvidia. So we've never really seen a company of this size scale at this pace before. It's quite unprecedented. And if we have a look then, so in terms of the valuation, a common metric that we talk a lot about is price to earnings ratio. So really this looks at what's the price of the stock in comparison to the earnings of that company. So it's often a good way of looking at, is it a high valuation, low valuation? And so Nvidia's forward PE ratio sits at about 24 times. Now, I was surprised when I heard that. That's not that high a valuation. Like it is slightly on the higher side, but certainly not for this company. To put that sort of valuation in perspective, other companies in the US, so Walmart, for example, that sits at a 40 times forward PE ratio, and Costco, for example, sits at a 43 times forward PE ratio. Put this in context domestically, CBA sits on about a 23, 24 times. So the same PE ratio, Commonwealth Bank sits on a forward PE ratio basis as Nvidia. And that's quite amazing, really. And to put this in context for the broader index, the S&P 500's forward PE ratio is somewhere between, it's about 22 times, 23, 24 times, that sort of thing. And then, comparatively, the ASX 200 is a bit lower. It is about 17 times. So you get the picture here. So with the revenue growth and profit growth and based off that PE ratio of Nvidia, I mean, I can't believe I'm saying it, but you would expect that it should continue to strive on with the share price where it's sitting. So, I mean, I think that looks quite promising. I mean, of course, there is concentration risks in having such a massive portion of the US market and global market in one company. There's things that can happen, of course, but I mean, the company in itself off, traditional valuation metrics, I think it's still got some way to go in the share price, unbelievably. But, if we look outside of Nvidia at the other big tech firms that are really driving this, the US share market and the revenue, it's not just Nvidia. So Google's revenue was up 22% over the last 12 months. Apple up 17% over the last 12 months. Amazon 17, Microsoft 18, and Meta up 33% over the last 12 months. So again, no surprises here. It's the big tech firms driving it, but it's the revenue and the earnings growth that is driving what we're seeing in the share market. So look, my point here is that, we've spoken previously about the concentration risk and the top heavy nature of the US share market with these big tech firms, and that's still there, and we still have that concern. But, I'm not personally as concerned by the growth that we've seen in the share market because I think it's backed by earnings and profit. So, I mean, I'm not thinking that it's, way overvalued and there's a crash coming. I don't see anything to indicate that. Of course, things always come from left field, which can impact the share market. But look, I think it's looking fairly priced, and it's going to be really interesting the next 12 months in the US share market as well, because there are some big IPOs coming, which have been widely spoken about. So the big one is SpaceX, Elon Musk's company. That's going to be one of the biggest IPOs of all time. So they're talking about a valuation of $1.5 trillion for that SpaceX. So that's what's going to hit the market. So if it does come in at that valuation, it'll walk straight into being the seventh biggest company on the US share market. So IPO walking straight into being the seventh biggest company on the US share market. So that's pretty unbelievable. I mean, IPOs have been sort of hit and miss in the past. They often get highly pumped up in their valuation early and then they don't do too much. But look, I think the positive in this is that there's just another different, innovative, interesting growth company coming into the US share market to add to the mix. So that'll be really interesting, the SpaceX IPO. So it's due to happen on Friday, the 12th of June. And at the time I'm recording this right now, it's Thursday, the 11th of June. And this podcast isn't airing until the 16th of June. So it will have already happened by now if you're listening to me. And then the other two big IPOs that have been widely spoken about are the AI companies. So OpenAI that does ChatGPT and Anthropic that does Claude. But we don't know the timing of that, but they have submitted their intentions to get listed on the stock exchange as well. And I mean, it's expected. We don't know, but expected that could happen in the next 12 months. So they're going to be really interesting to see how those big sort of growth companies, wide-reaching growth companies, are going to impact the US share market. So it's going to be interesting over the next 12 months. So the long short of all of this is, the question, am I concerned about the recent growth, massive growth in the US share market? No, I don't think so. And am I concerned about, the growth that's likely to happen and what's going to happen in the US share market over the next 12 months? No, I don't think so. I think there's some exciting companies that are be coming into the S&P 500, and I think that there is some, continuing good revenue growth and profit growth that should be likely to happen in the US share market. Of course, we don't know. We don't have a crystal ball. We don't know what's coming, but based off what I'm seeing at the moment, I don't have any major concerns. So jumping into the list of questions now, the first one's from Jeremy, and Jeremy was making reference here to episode 402 on Investopoly, which is the real risk in retirement, working too long and spending too little. And he said that he really liked that approach. And his question, he says, in our case, we have substantial debt-free investment in our home. And would you factor these into the calculation? So if we do nothing, these assets will just pass on to our children. Should we think about selling and renting accommodation, or would a reverse mortgage make sense to access more equity before we die? So it's an interesting one, Jeremy. Look, I would think that would be the last thing you'd do, of course. So I would, knowing that equity's there in the home, that'd be the last thing to go. Of course, you'd go through any other investments that you have in terms of liquid investments, your shares, your super, even investment properties if you have them. But I think, if there is a huge amount sort of locked up in the family home and a lot of equity in there, and you go through all those other assets, then I'd be leaning more towards, downsizing. So just to release some of it. If I don't know your numbers here on how much the house is worth, but if there's a lot tied up in it, then that could just allow you to just spend much more freely in retirement. And, you might be quite happy to do a bit of a downsize, clear a large amount of equity out of it, and then use that to live off. So the downsizing would be the way. Yeah, it gets passed on to the children if you don't do that, of course. And then on the point about reverse mortgage, look, we're not big on reverse mortgages, to be honest. There's interest that comes with that. And we haven't really done, I can't recall any for our clients that we've worked with. Maybe they just, in retirement, they're not in a position where they've needed to do that. But I would be leaning more towards the downsize if there's substantial equity. Clear it tax free. You don't have to pay any interest on a reverse mortgage. So I'd be leaning more that way. We're not crash hot on the reverse mortgages, if I'm honest. The next question now is from Peter. Peter says that he's turning 60 in May, which has already been and gone. So he's 60 now, and he says he'll access his 2.1 mil in a wrap growth super pension account. He has another 200,000 in a separate industry super fund, and his wife has 250,000 in her own wrap super account, which she can access in 5 years when she turns 60. So she's a bit younger than Peter. And she intends to work this year, next year, after which she'll retire. He mentions that they've also got a property which generates about 30,000 of income annually. It's an inner city Melbourne apartment that the sons are using at the moment. But his question is, should we be putting extra funds into his wife's super account apart from her monthly $300 contribution for the next 2 years? Her annual part-time wage is about 30,000. So firstly, well done, Peter. You're in a great position. 2.1 mil in your pension account, wrap pension account. Once you commence pension on that, which I'm guessing you've probably already done by now, everything turns tax-free, and all the growth that you've earned, all the unrealised capital gains, it all goes tax-free. So you've done really well there, and you're maximising the transfer balance cap, getting it all a lot in pension phase. So great job. And you've also got the other 200,000 in industry super fund, which won't be able to be in pension phase, but still in accumulation. That's really well done. So in terms of whether your wife should be putting more in, and I'm guessing you're talking about concessionally, but it could be non-concessionally into super as well. Probably not a lot is the answer. I take the mathematical approach here. So if her income's 30,000, then the tax-free threshold is $18,200. You never want to make deductible super contributions so much so that they reduce someone's assessable income below $18,200, the tax-free threshold. So in the bracket of which your wife's in, she's in the tax bracket of 16% tax plus Medicare levy. It's 18%. So the thing you've got to consider is if she makes concessional contributions into super, those get taxed at 15% in super. So you've got to look at the difference between the tax you save personally, 18%, and then the concessional super tax, 15%. So it's not much, it's not going to change the dial hugely, but there's a 3% tax saving by your wife making small super contributions, which would reduce her assessable income down to 18,200. So in short, I don't think she should be putting in anything more than 11,800 as concessional contributions. And it's not going to change the dial massively, but there is technically a 3% tax saving there in doing so. And then the question is, she should be making non-concessionals, certainly. So with any surplus cash flow that you then have after that, you've got plenty in your super fund, and you've got access to 2.1 plus 200,000 in super. So you don't need to have any more outside of super, even though she's 5 years away from being able to access it. You've got full access to your super fund at the moment. So I would think any other surplus cash flow that you have in your overall budget personally, I'd be putting it non-concessionally into the wife's super fund, and you can do up to 120,000 this financial year, and in July it goes up to 130,000 per annum. I don't suspect you'd have that level of surplus cash flow, of course, but there's plenty that you can put in non-concessionally. I think that'd be the way to go, Peter. I hope that helps. Next question now is from Mark. So Mark is 43 and his wife is 40, and their goal is to retire when his wife turns 60, so in about 20 years, and then have the flexibility to travel overseas, that sort of thing. Mark outlines some details on his current situation. So income-wise, he earns about 300,000, and his wife earns about 150,000, so 450,000 combined income. Their home's worth about 2.6 mil, and they've got a 1.4 mil mortgage on it. They've also got an investment property in Geelong worth 750,000 with $560,000 debt on it, which is on interest only. They've got about 200,000 in ETFs/direct shares in Mark's name, and they've recently started a strategy he mentions of reinvesting the dividends from that portfolio into his wife's name via a Vanguard investment. So kind of shifting some of that weighting over into his wife's name. Super-wise, they've both got 300,000 each in super. There's about 40 grand in an offset account, and then no other debt. They mentioned that they've got 2 kids that are in private school at the moment. That's costing them about 50 grand per year currently. So one's in year 8, one's in year 5. So what have we got? Another 7 years until you're private school free. Fee free, I guess. So that's doing a bit of a drag on cash flow at the moment, understandably. They've mentioned they also want to spend some money on renovations over the next 2 to 4 years. The question is, if your goal was to maximize their position over the next 10 to 15 years and retire comfortably at 60, what would you do differently from here? So they mentioned some specific questions. Should they be prioritizing debt reduction, investing more outside super, borrowing money to do the renovations now? And the current structure, is it correct versus, in Mark's name versus his wife's name? And would you double down on property or focus on building a larger ETF portfolio? And he mentions here we're underestimating what we'll actually need to retire with the lifestyle that we want. So broadly speaking, Mark's just wanting some advice and commentary. Of course, this is not personal advice. This is just information only and just some comments on your situation, Mark, of course. So, Mark, I know it can feel, as you've mentioned here, it feels like you're not making much ground sometimes, and it often can feel like that. I hear that a lot from clients as well, and I feel that personally as well. You sometimes feel like you're not making much ground in terms of building your asset base, and if you zoom out You should be. Sometimes in the moment, in the short term, it doesn't feel like you're making much ground. But, to give you some context here, so you've got 600,000 combined in super and you're only 40. Now, some simple numbers. If you get a 7% return annually on both of your super funds, it should double every 10 years. So, the 600,000 will be 1.2 by the time you're 50. And then by the time you're 60, it should be 2.4 mil. And then that's not even including any contributions at all. That's just if the money was invested getting a 7% return per annum. So if you put that in context, you are okay. You're doing all right. You're on a good track here. Firstly, what I'd be doing is you haven't mentioned, but of course, maximize super contributions up to your concessional cap. I'm guessing, I don't know whether you're self employed or a PAYG employee, but if you're an employee, your employer would be maximizing your 30,000 concessional cap this year. That's not going to be a big part of it, but as long as you're doing that every year, make sure you do that. Same for your wife; she would need to top up a little bit because her income's only 150,000. And if you've got any unused carry forward concessional contributions from the last 5 years, I'd be using them. As you can, because your balances are 300,000 at the moment, and before you know it, you'll be getting close to 500,000, and that's the cutoff point of which you can't use those unused carry forward concessional contributions from prior years. So make sure you do all that, but then I wouldn't be doing any more than concessional contributions into super, because I think that's largely going to get to a good balance by the time you retire. So, assuming you do make those super contributions, you've mentioned here that you think you've got surplus cash flow of about $750 per month. So, pretty tight on cash flow at the moment, understandably. That's not going to last forever. As I said, your youngest will finish school in 7 years. So, that's going to free up $50,000 of after tax cash flow at that point in time. So, things will get better, and interest rates are pretty high at the moment. But look, I think structurally things are pretty good. I can't comment on, I think you need to form a view on the investment property and what the future capital growth will be on it. Everything's got an opportunity cost. So if there's money and borrowing capacity tied up in an asset that doesn't have good future earnings potential, then there's an opportunity cost because you could have done something better in something else. So, but I'm not saying that I don't know the address of the property, but it's up to you to weigh up whether you think that that's going to get good capital growth over the long term. And that's one thing to consider, whether you think it is or not. And if it's not, then there's an opportunity cost and you might consider parting ways with it and reallocating, deploying your borrowed funds and the equity in it into something else. And if I can just loop back to the point of talking about super before, bit of a tangent here, but it ties into the federal budget proposed changes that are in it. Really what this does is this puts investing in super from a taxation perspective just even further ahead from in terms of an investment entity perspective and where you should build investments. Super was untouched. Well, nothing's been touched technically at the moment because it hasn't been passed the legislation, but based off what they're proposing, super's completely untouched in this. So, if we think about your ETF portfolio and personal name, well, there's a different CGT application there, and they're talking about minimum 30% tax on CGT. And, there's a big hit on family trusts and a big hit towards sort of investment companies under family trusts and all these other types of entities, which previously had some benefits from a taxation perspective. So, all of this just really leans it a whole lot more towards investing in super. And I mean, if there's anyone out there that is not focusing or not at least making their concessional contributions and paying attention to super, you're a bit mad, really, because it's sort of unbeatable. We don't need to put everything in it. I don't think it's the way to just put all after tax money in it, but certainly, like for the vast majority of people, and particularly people like you've got a combined income of 450,000. If you're not maximizing those concessional contributions every year, getting the tax deduction and getting the money into a tax-friendly environment of super, in particular if you're doing retirement planning, then you're a bit silly. So, of course, I hope that you are doing that, but that's sort of just a comment around super for everyone else listening. Because, of course, I know I sound like a financial advisor here who's just harping on about super, and I don't mean to. We look at it just from a factual, evidence-based perspective. It really is unbeatable in terms of long-term planning as a tax-friendly environment. Now, back to your question here, Mark, about should you double down on property or focusing on building up a larger ETF portfolio? Well, I don't think you would be able to double down on property. I think you're pretty much stretched on your borrowing capacity. I'd imagine you might have maybe an additional couple 100,000 in borrowing capacity at the moment. So that's not going to get you towards a property of any significance. So no, I wouldn't. I wouldn't be doubling down on property. I'd be, you've got the home that's worth a lot, and you've got an investment property, and let's hope that that's a good one. So no, I'd be focusing on all other assets around it. But you could potentially, something to consider is using a bit of gearing into the ETF portfolio. So if you have, based off my estimates, a couple 100,000 of additional borrowing capacity, you could use that to sort of kickstart and move along the ETF portfolio. So there's nothing wrong with doing that. You've got the equity in your home and borrowing capacity. So how that just works, I'll just quickly mention. I mean, to borrow money to invest in shares, that's, you've got to secure that against a property, and so you need equity in the property in order to do that, because the banks won't use the share portfolio as the security. But as long as you do, and you've got plenty of equity in the property, and you've got serviceability to meet that loan, the banks also won't really take into account the dividend and the yield income from that share portfolio. So it's got to all be down to your personal income. But I think that you would have a bit there. So you could do that. Interestingly, it's changed the dial a bit going back to the federal budget here. It's interesting that you can still negatively gear with share portfolios. So you can't negatively gear into newly bought established properties, but you can with newly bought new builds. But with established properties, you can't do the negative gearing, but it's no problems to do it with share investing, which is interesting. So it kind of creates a bit of a fork in the road, I guess, or a difference between the two asset classes in the tax treatment from a gearing perspective. So that's interesting. So you could still do that. That could aid things along. If you were to do that, you'd use the borrowed funds to then investing in your portfolio, because you're in the higher tax bracket and it would be negatively geared. You borrow at probably 6.5%, and share portfolio might have 2 to 3% yield kind of thing. So it's negatively geared, and you'd want the tax deduction being in the highest tax bracket. That's something else to consider. I would keep the investment property if you're going to keep it. I'd keep the loan on interest only as you have. Obviously, whenever you, pretty much as a blanket rule, if you've got non-deductible debt versus deductible debt, you should have, I think, the deductible debt on interest only, and then you should be focusing all of your principal repayments towards the non-deductible debt. Sort of an obvious comment, but sometimes I see it not that way. I think principal and interest on the mortgage. I'd drip feed. I don't know what the split is in terms of your cash flow. I don't know if I'd be going 100%. On a mathematical basis, paying off the mortgage, but doing additional repayments, putting money into the offset account. If your mortgage interest rate's about 6% at the moment, then that's the after-tax return you're getting on that money. You're getting 6%. Whereas if you can go into other asset classes, and if you think you can get better than that on an after-tax basis, then mathematically that's a better return on investment with your personal cash flows. So do you think you can put it into, shares and get sort of 8, 9% sort of thing, maybe 8%, and then after tax it's sort of 7%? Well, then mathematically you're ahead in that regard. And then you could, rejig things, and it's going to put you in a better net asset position. And then you can rejig your position later on down the track closer to retirement, if that makes sense. And finally, look, is your structuring right in terms of the ETF portfolio? Look, maybe it should have been better, more in your wife's name, but you're addressing that now. You're kind of drip feeding it across more of it, the investment, into your wife's name. So generally how it should work is if there's investment with cash, it's better to go into your wife's name because she's in a slightly lower income tax bracket than you are. So it's technically better from a tax perspective that dividend income is at a lower tax rate to her, being 37% or 39% with the Medicare levy versus 47% in your name. So that makes sense. But then interestingly, if you go down that borrowed route using borrowed funds, well, then that's better in your name. So that's kind of the structuring balance I'd be trying to work out for you. So, look, a couple of little thoughts there for you, Mark. I don't know if it's massively changing the dial. I think largely what you're doing is working pretty well. Don't worry. I see your concerns here about, feeling like you're not moving in the right direction. There's nothing in there that massively jumps out apart from little tweaks and touches that I've said. Just have confidence in the fact that, I think it will work if you stick to that plan and you do things appropriately. Then you will get there. You're only 40, so don't stress. Probably got time for one more question now, and the final question's from Adam. So Adam's question's about his self-managed super fund. So he mentions that he's 46 and he's got a self-managed super fund that holds a property in Townsville worth about 750,000 and a loan of about 375,000. Inside the self-managed super fund, all else that he's got is about 40,000 in cash. Now he mentions that he earns about 120,000 per year, and his salary sacrifices into super. So looking ahead, his question here is about, would we prioritize in relation to the self-managed super fund? Would we prioritize building up cash reserves and liquidity within the fund, or aggressively paying down the loan? Yeah, good question, Adam. It really depends on the interest rate. Self-managed super fund loans, they get hit with a higher interest rate. I saw one the other day that was about 9%, 9 something percent. So they can be eye-wateringly high, some of those interest rates, but it sort of does depend on that, because there's one approach that I take, which is just the mathematical return on investment of cash flow allocation. So it's, if you pay down a loan, and it depends whether it's deductible or not, it is deductible, because it is an investment load inside super, but the negative gearing deduction is only 15% because the tax rate inside super is only 15%. So, you've got to look at what's the return on investment on an after-tax basis by paying down that loan versus investing it. I wouldn't be parking it in cash, and you often can't have offset accounts in the self-managed super fund loans. So I'm assuming here to be building up, the liquidity within the fund in probably a share portfolio. So the question is, can you, based off historical returns, can you get a better after-tax return by investing the money in a share portfolio versus the after-tax return by paying down the debt? Now, that depends on the interest rate of that loan, but that's one thing for you to consider. However, the other big thing, which I think then leans more towards I'd invest, and my thoughts would be you should invest, is the liquidity issue. So the problem, I recorded an episode in December 2024 called Property in Super, the Liquidity Trap, and the episode number is 337. So I'd encourage you to have a listen to that one if you haven't already. But in that podcast, I spoke about the issue of liquidity inside super. So it's quite a big issue that I think not a lot of people realize in owning property inside super. It works okay if you have property inside a self-managed super fund, but you really need to be having other assets in there, which are liquid assets, being cash, shares, other things of the like. And the reason being is because once you enter into retirement and you enter pension phase, there are minimum pension payments that start out at 4%, and then they work their way up to 5, 6, 7% as you get older. So if the yield on that investment property, and typically residential property is not a super high yielding asset class, if the yield's not good enough and all you've got is that property in there, then you're going to be forced into a sale of that property just in order to meet those minimum pension payments. So liquidity is a big thing. And so therefore, by actually keeping some of that debt, it looks at the total balance, the net asset position of your self-managed super fund. So if you can imagine that if you actually keep that debt in place, but then you build up your liquid assets, from an overall perspective, then the super fund might be in a fairly similar position, but then the actual makeup of that is that you've got far more liquid assets in there to pay those pension payments in the first, 10, 15, 20 years of retirement. So in a nutshell, if the return on investment on an after-tax basis is pretty similar from paying down that loan versus investing it in the share portfolio, then I'd be going to doing the share portfolio to build up your liquidity, because that's going to mean that you can hold on to that property for a lot longer in retirement and not be forced into a sale, hopefully, at a time where you might want to, because that particular market, the Townsville market, might be down, for example. So the longer you've got to choose in which to strategically to divest of a property inside super, the better. So I think that's the way I'd be going, Adam. But really good question, though, Adam. Very simple question, but a really good one that we actually get quite often. So best of luck. I hope that helps. That's about all the time we've got for today. So I'm going to wrap it up there. Until next time, bye for now.
Before I go, my new book, Wealth by Design, is now available for pre-order. Pre-orders matter more than you think. They're used by bookstores and online retailers to decide how many copies of the book to stock. So, as a huge favour to me, if you're considering buying the book, I'd really appreciate it if you pre-ordered it now rather than wait. And the part that I'm most excited about isn't really the book itself, it's the AI companion tool that I've built to go with it. I reckon it's a game changer, and I'd love you to see why. The pre-order links are in the show notes. Thanks a lot.